Imagine a scenario where the world's second largest economy is facing a housing market crisis, with home prices plummeting and demand at an all-time low. This is the harsh reality in China, where a recent gauge of new home prices revealed a 0.3% slide in July, marking the steepest drop in 8 months. But here's the shocking part. Despite a slew of government support measures, citizens' interest in property investment remains lackluster. The month-on-month drop in new home prices across 70 major cities matched the decline in the previous month, which was the sharpest since a 0.5% fall in October, according to National Bureau of Statistics data. To put this into perspective, new home prices have been sliding since April 2022 on a year-on-year basis, with a 3.4% decline in July compared to the same period last year. But what's behind this downward trend? The answer lies in the government's support measures, which, although well-intentioned, have failed to revive citizens' interest in property investment. Authorities have introduced a series of measures since September to support the housing sector, including cuts to mortgage rates and down payments, as well as easing home purchase restrictions. For instance, the Beijing municipal government made a surprise move to lift home purchase restrictions in the city's outlying areas, a step that analysts believe could signal similar measures in Shanghai and Shenzhen. Additionally, banks have been encouraged to provide developers with additional funding through the Project Whitelist scheme. However, despite these efforts, prices in China's 4 first-tier cities fell 0.2% in July from a month earlier, with the southern metropolises of Guangzhou and Shenzhen experiencing steady declines over the last quarter. But here's where it gets interesting. Shanghai continues to buck the trend, with prices rising 0.3% to cap more than 3 years of increases. So what does this mean for the future of China's housing market? The answer is complex, but one thing is certain. Demand remains lackluster, with cautious consumers opting to add to their savings rather than invest in homes. This, in turn, has extended the struggles of developers, which have been battling a liquidity crunch since a nationwide deleveraging campaign began in late 2020. The consequences are far-reaching, with China Evergrande, once China's biggest developer, set to delist from the Hong Kong Stock Exchange this month, nearly 4 years after it first defaulted. Other major developers, including Country Garden, Sunac, and Vanke, continue to wrestle with heavy debt burdens. And this is the part most people miss. The ripple effects of this crisis will be felt far beyond the housing market, impacting the entire economy. So we have to ask, what's next for China's housing market? Will the government's support measures eventually pay off, or will the market continue to decline? We'd love to hear your thoughts. Do you think the Chinese government is doing enough to support the housing sector, or are more drastic measures needed? Share your opinions in the comments below.